Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 365 on March the 8th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on B. Riley Financial, NIO Inc., and the iShares Trust 20-plus year Treasury Bond ETF. And we discuss three new trades on Marathon Digital, Devon Energy, and Barrick Gold Corporation. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, both major equity indexes finished the week lower, with the S&P 500 having its third consecutive week-over-week loss. The Dow Jones Industrial Average lost 1,039 points, closing at 42,801 points. The S&P 500 index fell 184 points, ending the week at 5,770 points. And now it's time for the topic of the week. The topic of the week is learning to think. My original title for this topic is Why I Love Economics. There are a lot of things happening in the economy right now. In fact, that may have been the understatement of the week. People are discussing tariffs, trade deficits, ongoing support of war, government budgets, inflation. The list goes on and on. I can teach you all of the relevant formulas to price options and consider risk, but those formulas will not teach you how to think about the world and what's going on right now. Now, I studied economics in college. Yes, the initial models of the world were full of assumptions that made them highly unrealistic. As we went deeper into the study, we removed those options and all those assumptions. You start to think about not only response, but reactions. What happens to prices when tariffs are levied? What happens to inflation due to those price increases, and what might that mean for the federal funds rate? How will the countries respond to our tariffs? What happens to the global economy as interest rates move and export inflation around the world due to balances of our domestic currency being held as a store of value abroad? These are not easy questions to answer, and understand that I am not discussing politics. This is economics. Feel free to dust off that old macroeconomics book or find a few discussions on YouTube to get up to speed. It might help your portfolio in the coming year. All right, so that's it for the topic of the week. Let's go ahead and get into the review of last week's trades. And given that most of our trades are long leaning, meaning they improve as the market goes up, just know that this was a challenging week for the trades presented once again. We'll start with our cover call on B. Riley Financial Inc., symbol R as in Romeo, I as in India, L as in Lima, Y as in Yankee. At the time, the stock was trading for $6.38 per share. I looked at buying stock and selling the March 6 half call at 98 cents, hoping for a return of 17.24% in 3 weeks. Well, shares of Riley Financial fell $1.97, ending the week at $4.41 per share. The call option we sold lost 92 cents, leaving us with a net loss of $1.05 on the week if we were to close the trade out immediately. That is significant given the small cash outlay on this trade. Now, my first thought is to roll the option strike lower by buying back the 6 half call that we sold and then selling the March 5 call at 25 cents. My plan is to let this expire out of the money in 2 weeks and then hopefully collect another 60 cents when I sell the April call against these shares. That would give me a much closer shot at recapturing my loss. Also, in selling the March 5 call, if the stock were to rally 59 cents to move to that $5 strike being in the money, then I'd get to add the 59 cents plus the 25 cents I collect on the option, lowering my overall loss on the trade to just 21 cents. Hopefully you followed all of that. Now, if the possibility of 2 weeks of exposure and a 21-cent loss is unappealing to you, you can definitely roll the strike by selling the April 5 call at 60 cents. In this scenario, if the stock rises to $5 over the next 6 weeks, you would lock in at least a 14-cent profit. I prefer the first scenario where I capture more premium in March and then sell the April call option after expiration, but that's just a matter of personality and how you want to manage the risk on the trade. Next up, I looked at a credit spread on NIO Inc., symbol N as in November, I as in India, O as in Oscar. At the time, the stock was trading for $4.63 per share. I looked at selling the March 4.5/4 put spread at 17 cents. That could give us a maximum possible loss of 33 cents per spread. Well, shares of NIO lost 19 cents, ending the week at $4.44 per share. The out-of-the-money put spread that we sold is currently at the money. The spread itself only lost 1 penny of value, and the stock price is still above the break-even price. So no real reason to make an adjustment just yet. You could fully close the trade and take the penny loss, or stay in it for the next 2 weeks and see how the spread plays out overall. I obviously like to sell higher strike call spreads against these as well to create the iron condor, but at this point, we're above the break-even point, so I'm just going to check out how I'm going to be aware, of how price moves over the next couple weeks and be ready to defend this trade if I need to. Finally, we have a debit spread from last week. We looked at the iShares Trust 20-plus year Treasury Bond ETF, symbol T as in Tango, L as in Lima, T as in Tango. At the time, the stock was trading for $92.44 per share. I looked at buying the March 90/2 91 call spread for 34 cents. That could give us a maximum gain of 16 cents or a 46.06% return in 3 weeks. Now, shares of TLT fell $2.33, closing at $90.11 on Friday. The deep in the money call spread that we bought is currently out of the money. The spread has lost 15 cents of value and the share price is below the break-even price. To put on my economist hat for a moment, I'm guessing the fall in the stock market is making investors feel more confident about a Fed fund rate happening on March the 19th, a couple of weeks from now. Now, because we are 73 cents below the break-even price, you'd certainly be justified to alter this trade or make an adjustment. You could sell the 90.5, 91.5 call spread at 37 cents. This would leave us with a short 91, 91.5 call spread that you collected a net total of 3 cents for selling. I would also then sell the 89.5, 89 put spread at 14 cents. This means we have an iron condor and collected 17 cents to sell it. It would leave you with a profit range in the stock price of $89.33 and on the upper side, $91.17 over the next 2 weeks. So as long as price finished between those, that trade would be profitable. That might not be a bad trade. Your maximum loss would be 33 cents after the adjustments, and your current maximum loss without the adjustments is 34 cents. I'd still lean towards waiting a couple of days before deciding whether or not I'm going to alter this trade just to see if the ETF will push higher again. It's always good to have a plan, and what I just mentioned was the plan, but you need to be ready to make a move when the time comes. But it's good to do the math as well, because sometimes you might see, like if I create that iron condor, it's a lot of movement, and all I'm doing is lowering my maximum loss by 1 cent, or that's really $1 on the whole trade. So is it worth it, or should I just wait to see if this trade is going to move forward? That's why I like trading spreads as well, because we're not trading unlimited risk, right? We have a limited gain, but we also have a limited amount of risk. So my maximum loss, if I just leave things alone, is 34 cents. Not too bad. All right, so that's it for the review of last week's trades. We're only 2 weeks away from March expiration on March 21st, so the trades presented on today's show are inherently more risky due to the lack of time to make better adjustments. We're going to start off with our covered call. I'm looking at MARA Holdings Inc., otherwise known as Marathon Digital, symbol M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. The stock ended the week at $16.02 per share. I'm looking at buying stock and selling the March 17 call at 76 cents, hoping for a return of 10.86% in 2 weeks. Then you enter this trade by buying stock for $16.02 and selling the March 17 call at 76 cents. This trade makes the most money if stock prices finish above $17 per share. The break-even price is $15.26 per share. In real terms, the stock purchase would require $1,602, and you would collect $76 for selling the option. Next up, we have a credit spread on Devon Energy, symbol D as in Delta, V as in Victor, N as in November. The stock ended the week at $34.71 per share. I'm looking at selling the March 34 put spread at 17 cents. That could give us a maximum possible loss of 33 cents per spread. You enter this trade by selling the March 34 half put at $1.04 and concurrently buying the March 34 put for 87 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $34.50 per share. The break-even price on this trade is $34.33 per share. In real terms, you'll receive $17 per spread that you sell and have $33 at risk. Our final trade on the week is going to be a debit spread. We're looking at Barrick Gold Corporation, symbol G as in Golf, O as in Oscar, L as in Lima, D as in Delta. The stock ended the week at $18.62 per share. I'm looking at buying the March 18 half call spread for 34 cents. That could give us a maximum gain of 16 cents, or that's a 47.06% return in 2 weeks. Now you enter this trade by buying the March 18 call for 92 cents and concurrently selling the March 18 half call at 58 cents. This is a debit spread because we're buying the spread. This trade makes the most money if stock prices expire above $18.50 per share. The break-even price is $18.34 per share. In real terms, you'll pay $34 to enter the spread, and your maximum gain is $16 per spread. So that's it for this week's show. I hope you guys are having a fantastic weekend. I've actually been skiing at Park City this weekend. I'm skiing again next weekend. I hope by now you realize that I not only love option trading, but I also love good memories and good experiences with good friends. And I'm here with a good group of guys that I went to business school with back at the University of Chicago. So hope you have a wonderful week. Stay current. What I mean by that is watch what's going on in the news. Be aware of how it's moving the market, right? Whether you agree with tariffs or not, or somehow, regardless of your political stance, be aware of how all of this data or all of this news is affecting stock prices, because you may see a couple of trades that are not as obvious, and it might be a great way for you to put on an option trade and make some money. So, and hey, if you have a great idea, email me, holla at your boy. I like making money too. So that's it. Hope you have a wonderful weekend. And as always, happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.